Today with Dana, the CEO of Hemlane, a property management software for smaller landlords and larger landlords, like myself, people with bigger portfolios than me, so that we can self-manage our properties and, like me, sometimes from another country. That's actually one of the main reasons why I've started using Hemlane. But you have, and I remember the numbers because it changes every time we've talked, because you guys are doing so much growth there. How many units are on the platform right now? How many rental units?
We have 28,000 rental units with owners using our paid services. A lot of them are remote, out of state, looking for not just the software, but to your point, Dion, the services. And then over 100,000, we've got a free plan as well. So over 100,000 there total.
Jeez. Um, and so that's kind of why I wanted to have this topic conversation with you about what Fed rates mean to landlords, right? And we know Fed rates aren't directly correlated with mortgage rates, and that's what
Yeah.
most people are going to assume is that, if the Fed rates go up or come down, then mortgage rates go up or come down. I will talk a little bit about what it's specifically doing for me when the Fed rates change and how it's impacted me in the last few years and what it's doing currently with this recent drop of half a base, a full 50 point,
Yeah, huge.
drop, which Michael Zuber from One Rental at a Time has talked about. If they did 50, it means the Fed is scared. They're really trying to get ahead of something. So from your experience with that many people using your platform, what do you think a 50-point drop in Fed interest rates does for landlords?
Yeah. Well, I think the ones it impacts the most are landlords who are looking to purchase more properties, right? And you would hope that, you're building up a portfolio. It's becoming more affordable. I think over the past couple of years, one, there's been really low inventory, so very little on the market. And then two, there's also you go through your pro forma and you say, this doesn't make sense, this doesn't cash flow because interest rates are so high. So I think that for those purchasing, there should be more supply on market because move up buyers are going to say, up, I'm good. It's a good time for me to sell because the interest rate has gone down slightly and get another home, which could become a rental property, could become a buy sell property. Also, an investor may say, hey, it's a slightly better time to sell because prices will stay higher or go up slightly potentially, but because the interest rate is down, and so you'll see more supply on market. For landlords who currently have rental properties, hopefully they learn from 2008 and they don't have a variable interest rate loan, although in this case it would benefit them, not hurt them. But I think a lot of people from 2008 said, I want a fixed 30 rate mortgage. So there's kind of two things there that happen to landlords who currently have properties. One is that they could refinance and get a better rate and more cash flow. The second is an interesting one, what happens to their tenants. Because when you're looking at your cash flow, if a tenant could could go and purchase and move out because interest rates are lower, they can now suddenly afford a property, you might see slightly more turnover. That's a little bit harder to predict though, because we're not quite sure what's going to happen with prices. Some of the projections out there and economists have said, hey, prices are going to either stay where they are or increase. And again, this was a federal funds cutting the rate, which is there's assumed there's going to be some sort of correlation and parallel in the mortgage and interest rate. So that's what I have, Dion. What am I missing?
No, and so I don't think you're missing anything there. One of the main reasons I wanted to do this, first, it's a live stream, so people can ask questions of you. And there have been several questions during my live stream where I say, that's a great question for Dana. I should ask her the next time she's on. So this is
Great.
a chance for people to get that in there. And I wanted to give my perspective. I think what's trending on YouTube right now, and I try not to make very many trending videos because I like to make evergreen stuff, right? How to screen a tenant in 2021 and screen a tenant in 2024 is kind of the same. So I make that video, it's up there forever. But something like this rate cut right now, every content creator is going, here's my rate cut thought. So I try not to do that. So I'm not talking about this rate cut. What I want to do is evergreen content. How have rates changing impacted me as an
Yeah.
owner? And you have so many more owners that you deal with. I would want to bounce it off of you and you can go, I've seen that, or there's my counter thought or whatever. because I don't mind if we disagree. I just want to say this is my personal experience. The person who benefits from my personal experience when interest rates go up or go down is the owner, the person who already owns the properties. The asset owner benefits from inflation. Inflation makes you richer, right? Bidenomics has tripled my net worth in the last 3 years, right? So as a selfish, greedy landlord, great. As a person who knows that the only cost was the working class and the middle class being able to not afford and prices going up, I don't want to see more of that. I just
Yeah.
know that it's a fact. So when interest rates went down really far, 2020, they tried to spur the economy, save everything. Prices spiked up. So then interest rates went up, and a bunch of crash bros were saying if interest rates go up, prices have to come down. And we know that's not what happened. It's what
Hmm.
we said in the one rental at a time community, said we weren't going to see prices come down. We were going to see maybe they flatline, they don't go up as fast. So we've seen that prices are still high, interest rates are high, so it's harder to buy. So now interest rates are coming down. And what this will do, and this is what this has done for me, is it's so weird. I'm trying to find the mix that costs the buy and hold investor. Right. And real estate's local. Your local market can have a crash. I guess that could happen. All
Yep.
the car manufacturers move out of Detroit. The dot-com crash hit Silicon Valley really hard. So locally, you can be hit. But I spread my properties out in several different counties next to different economic drivers as a form of diversification. So when interest rates went down, prices went up. When interest rates went up, not only did prices not come down, but it became really hard to buy.
Yeah.
So if it's harder to buy, more people become renters. What does that do for rents? Rents went in the last 4 years, my rents have gone up about 40%, and I'm below the area average increase of what's happened in my market. So we've seen appreciation when interest rates went down. We've seen rental appreciation when interest rates went up. And now we see interest rates go down. And a lot of people, I hear often, I think if interest rates come low enough, somebody's going to sell their house to buy a bigger one. And that's the move up buyer. And I think that there is a component of the United States that is that, but I think more so what we have is a lot of people who own properties who didn't sell because interest rates were so low, they had a good payment. Well, if prices went up and interest rates went up and now interest rates come down, prices will push up again because we've opened up more demand. And there is a point where somebody who owns a property, it's either vacant or they've got a tenant in it, or they're living in it, or they've got two homes, will just look at that and go, there's so much money there, I should sell. But they're only going to sell because of the price increase. So
Yeah.
it's not a type of inventory that's going to drive prices down, because if they put it up and there's enough to where prices would come down, they just won't sell. They have a number that in their head makes sense. I'd sell it for 600,000. That's really high, but interest rates came down. So somebody who's buying based on payment will buy it. So you see prices push up again when the interest rates come down. I haven't seen in over a decade the reason why prices come down, except for those adjustable rate mortgages that you talked about. So yeah, there are some people who have it right now. If you got an adjustable rate mortgage in 2020, you saw your rate double or triple, and it would be terrible. If you
Hmm.
got it in 2023, this is now, it might be coming down a little. And in 2007, there were 51% of the mortgages out there were adjustable rate mortgages. And the problem was also a lot of them were ninja loans. So no income, no job, no assets. You could just go into the bank and say, I
Yeah.
make this much money and get a loan, which I'd like to talk to you about when we go to the lending issue of being an entrepreneur. That made a lot of sense. And you could borrow 105% of the value. So you can wrap the closing costs into the loan. So the 2008 housing crash didn't happen because of prices. It happened because rates adjusted. People borrowed more than they should, borrowed more than the place was worth. So they were already underwater, even if prices stayed the same. And then their rates adjusted. And then we had unemployment hit. So you had all of this toxic debt that was sold off, caused a cascading effect. We have had in the last 5 years adjustable rate mortgages all the way down to 3% of mortgages, all the way up to 11% one year, but it's back down to around 8 right now. So it's a much smaller amount of residential. And I'm talking 4 units or less, 5 units or more. It's almost all adjustable rate. You can
Yep.
get fixed rate debt on up to 10 units with a DSCR loan, but that's not as common as you just go get a commercial loan. So I think if we're going to see any pain or price adjustments, it's really going to be in that 5 units or more, because of the way the debt's set up. So what is happening to me as an owner in 2020? Interest rates go down. So I buy some properties. Uh, Values went up because with the lower rate, you could buy more, have a better, lower payment to pay more for the property. 22, 23, rents went up because rates went up and prices went up, making it harder to buy. So we're in 2024. We see this little dip in the rates, which might continue. There might be 2 or 3 cuts where the rates continue to go down, which is going to create more demand. And so it sucks to say this out loud. The asset owner gets richer
Yep.
and richer and richer. And the person, and I saw this on Facebook today, so I would want to give credit to the person who made the post, but it was like in 2020 you were waiting for the pandemic to be over. In 2021 you were waiting for prices to come down. In 2022 you're waiting for rates to come down. In 2023 you're waiting for prices and rates to come down, and you still don't own a rental. We're 4 years into doom and crash bros and all of those kind of things,
The
and it's
best
costing people money.
Yep. The best time to buy a property was obviously 10 years ago. The next best time is today. I couldn't agree more with that. I think, especially what I've learned even in 2019, when I was buying a property thinking prices were at a high, it was like, wait, no, but the interest rate is low. And so even, 2 to 3 months ago, if like, oh, prices seem high, but it's like, no, should have locked in. You can adjust that mortgage and the prices increase. And so I think it's really interesting because, to your point, there is that American dream and getting on that ladder of purchasing real estate. And what I love about real estate, obviously, is it's a physical asset. And there's these certain things that happen, like you can refinance now even when prices are that high. And so don't be too worried. You can look at your cash flow and say, does this cash flow at this rate, lock it in, and then refinance later. And so I couldn't agree more with you on just the especially what you're mentioning of under 4 units, under 4 units of non-commercial loans, the opportunity that you have as a landlord to really hedge and mitigate risk associated with purchasing that property, because you can lock in price, you can lock in your interest rate, and then anything else could be upside as long as it's cash flowing as of then.
And one of the things I like is the assumption isn't that prices always go up.
Mm-hmm.
The assumption is you can benefit almost no matter what's happening with prices. If prices stop going up, one, because people can't buy. Let's say prices are so high and interest rates are so high, it's really hard to buy. So then you rent. And what happens to the people who own the rentals? There's more demand on limited supply. I
Yep.
personally go to all of my tenants when we're signing leases or when I meet the tenants the first time, and I tell them they shouldn't be renting. I say, I'm the guy who created a YouTube channel that teaches people how to buy properties, reach financial freedom. Instead of renting half of the side of my duplex, you should be buying a duplex. I'll give you an agent. I'll talk you to the lender. And now I've been doing this for over 10 years. I've finally had 2 people get on the property ladder. None of them have purchased. Well, one inherited a house before that, but 2 purchased houses. But nobody purchased a duplex. Even with me encouraging it all the way through, they bought
Yeah.
house.
Yeah.
So I don't think we see the competition that we would expect as far as buying, but we do see competition when it comes to renting.
Mm-hmm.
Not too long ago, I had a young couple that purchased a house, and I did a tenant turnover. And I do property showings for a couple of reasons. Open house format when I'm in the country. I want all the tenants, the applications to show up at the same time. And the applicants think this is because it creates demand. But for me, what it does is I get a very microscopic view of a macroscopic reality, making a decision of having a tenant or not. And I have other tenants because I own small multifamily, duplex, triplex, fourplex. And I'm going to be picking somebody who has to live next to my already existing tenants. I want to see how they interact with other people because that's
Yeah.
part of my criteria. Are they rude? Are they dismissive? Are they in that sense of entitlement or whatever? Or do they wait till someone else is done with their tour, ask questions? Are they polite? I'm like, okay, I would totally rent you. And then I go through my other criteria as well. But the demand was there because we have high rates and high prices. And as we see the rates come down, we're going to see the demand increase more. So I see a question here from Frank, old guy REI. And this would be a good one for you too, because you probably have people who have properties in Indiana. He says, my tenant in Indiana applied for rental assistance and were approved. Is it common to ask for a small rent increase while they are getting assistance? Their lease is ending next month.
I would have a couple of questions on the rental assistance before answering that. So how long is the rental assistance for? And would you be planning on renewing their lease anyway? Right. Because the reason I mentioned that is if there's a couple of scenarios. One, they're a fantastic tenant. They're very responsible. They're worth, keeping in there because there's not, constant drama or anything like that, Dion, to your earlier point. And then the next would be obviously like their ability to pay. If this rental assistance is going to dry up at some point, it's only for a certain period of time, or it's not like a Section 8 lock-in. The concern would be you raise that rent, very short-sighted of 3 months of it. December comes around, no one is moving. And it's a holiday. So December is like the slowest month for moves. And then suddenly you have this tenant who can't afford to pay rent. They have to move out, and you have a property vacant for the winter because Indiana is cold during the winter time. And there's snow. So from that perspective, I learned a little bit more about the rental assistance. And then the real question with it is, with the rent increase, are you going to lock them into an annual, or are you going to put them on a month-to-month lease? There's obviously pros and cons to both, which we can definitely go over. I'm not always a fan of locking someone into a 12-month lease. There's certain reasons for that. But yeah, you would want to learn a little bit more and write out the different scenarios. But if you can learn how much is this rental assistance, why do they even need this rental assistance, it will help you, because the last thing you want to do is increase it and then they can't pay it and you have a turnover in February or December, or one of these months that's slow. Actually, January is actually an okay month. January 1st does have quite a lot of move-ins, but December and February, if you hit those I found to be pretty terrible months to do turnovers in.
That's actually ironic. I almost all but one of my leases ends in December. So January is my preferred month to have lease renewals in, because nobody wants to move. So I have very limited turnover. So I go the opposite.
I love that. Yeah, no, totally.
But I agree. December, it would be harder with the holidays, and February, it's colder here too, even in the Pacific Northwest, where we don't get as much cold as Indiana.
Yeah.
And then Frank clarifies with they're on 6 months, may go month to month. So here's my thoughts, Frank. I think Dana had some really good insight there. What is the rental assistance? Because I've had tenants go, I get 1 month or 2 months paid because they qualify for some program. Great. It helped them get on their feet a little better. If it's the version that's called ERAP, Emergency Rental Assistance Program, I wouldn't touch it with anything. I wouldn't have those tenants or renew with those tenants, because that turns into an eviction. Almost 100% of the 13 people that Matt the Lumberjack landlord used that program with last year, because he has a big portfolio, it was totally fine. I only have 18 rental units, so I wouldn't want to do it with mine, but he has 140. So doing it with 13, he took a risk, turned almost all 100% into evictions. But I have had tenants that have a church that pays for a month or two, or a local nonprofit or something like that. I'm totally fine with that. And the way I look at rents, Frank, what somebody is paying for rent or what somebody was paying last year for rent has nothing to do with the rent next year. Area average rent set rents, because area average rents set your expenses. This is going to impact your property taxes. It's going to impact what everyone else can pay handyman and contractors. So it's going to impact what you can pay handyman and contractors. So what is their rent now compared to area average? I don't go to or above area average unless it's a turnover. So on a tenant, binder strategy or a small increase, I would be on board with that. How does their current rent compare to area average rents in that area? So a 2-week rent study would be needed to do that. And then on the 6 month or month to month, and this is something I would actually like to have saved for my conversation with Dana about how an entrepreneur can sometimes struggle to get a mortgage. A month to month lease hurts your lendability. When lenders look at lending money to a landlord or entrepreneur, they're going to look at your tax returns and your leases. And what I've had lenders say is, we want the majority, which means 51% of your leases, to have at least 3 months remaining. And you can't possibly have 3 months remaining on a lease if it's month to month. Yeah. So Frank, if you want to continue to add mortgages, which I know you're working, Cynthia's retiring very soon, and you're getting these properties in place to do that, you want to be bankable. So I would want long leases. So the young couple that was buying a house that told me, hey, we're buying a house, we're going to be doing this. We were doing a lease renewal. And I said, absolutely, we're going to do a lease renewal because I need a 12-month lease on all my tenants. And we did a $50 lease termination fee. So they can buy their house, they can get out of the lease. I don't care if they give me the $50 or not, but what I have is a document that I can send to my lender saying I have a 12-month lease. So I'm bankable for the next mortgage or refinance, because I want to be bankable because I'm in the middle of a current house hack self-funded burr where I might get a mortgage at the end. So I'm even still considering these things. But Frank, in your position, I would definitely want a longer term lease to Dana's point, I don't know that in Indiana, I would want it to end in the winter. I kind of agree with Matt, the lumberjack landlord. Based on the colder climate, it's really hard to find a tenant in the winter. I haven't had the same luck in winter as summer here in Washington, so I'm fine with that. But Indiana's different. So I hope that helps you make your decision. I don't know that I would jack it up a bunch unless you were 50% of area average. Then, of course, I'd rather have the tenant turnover or binder strategy. And if somebody had $1,000 a month rent and made $1 million a year, and someone offered to pay their rent for 2 months, they would take it. I don't think rental assistance just instantly screams they're financially unable to do this. My tenants that had their rents paid for those things didn't lose their job, weren't stopped working, just went and applied, somehow qualified, and got it paid for. Now, that doesn't mean that there could be somebody who has serious financial problems and that's why they qualified. And then you're going to be going through an eviction, whether you raise the rent or not. That's why we have reserves, why you don't want to have all of your eggs in one basket. So there is a question here from Michelle, and I want to make sure I get the first half of it because it's in a couple pieces. Michelle, howdy, Michelle. Michelle recently did a 1031 and acquired a couple of small multi-properties that way. Dion doesn't require 3 times income, which is true. How do you approach someone that maybe doesn't report enough to cover rent expenses? Do you question them? So Dana, if somebody's applying through one of your landlords who has their properties or one of your rentals, and they don't meet the 3 times or 2.5 times requirement, how would you approach that? Because I have a way I approach it when they don't meet like my credit score or they don't meet something else. But what would you do if they don't meet the income requirement?
Yeah, good question. And I'm just related to the 3x versus 2.5x. Some of these cities that are very expensive to live in, there is a case to be made for 2.5x. Typically we recommend 3x. So rental is $1,000 a month, obviously 3,000 in income. You need as much data and criteria as possible on it. And so kind of the other factors that are in it is, one, what is their assets? Are they a trust fund kid? If they are a trust fund kid and they've got $1 million but 0 income, then there's less risk there. I would take the caveat that a lot of trust fund kids are terrible with money, and so I also would pull their credit to make sure on the credit perspective they're good. The second thing I would do is look at cosigners. And so if they have some sort of cosigner to back them up that has income, there's a lot of times where a parent will help their kid pay their rent because they're just getting started. They're 23. They just got a job. It's their first job. They're making really low wages. If you have a cosigner, there's that. The other one that might be brought up, but Dion, I want to hear from your perspective too. The other one that could be brought up would be collecting some rent up front. And the only reason I'm not a fan of that, there's some folks that are like, great, you have to pay and come up with the cash, 6 months, 12 months in advance. Only reason I'm not a fan of that is it makes evictions really hard. So let's just say they've paid the rent, but they have a marijuana lab in their place, which and it's or maybe a meth lab, I think would be a better extreme. You want to evict them, but legally you've collected rent for a certain period of time, which makes it a lot more challenging to terminate the lease. And so from that perspective, I'm not a huge fan of collecting 12 months upfront. I've seen a lot of landlords do that. Most professional property managers, for very similar reasons, would say no, they won't. But yeah, you just have to look at those other factors that are involved. The other thing you can do is figure out, like, if it's a 2-bedroom and it's only one person, it's like, great, you have a roommate who you want to move in or anything like that. I think is very helpful. But you just want some more data and stats to understand their financial situation. What did I miss, Dion?
No, so I think that's good. I don't look at income because it eliminates a lot of people who make a lot of their money through tips, like cosmetologists, bartenders, waiters, those type of people that end up making pretty decent tenants. Okay. Cool.
Oh yeah,
So,
tips is a good one.
yeah, and I do still, and Michelle clarified their credit is 650 or better, so she does meet their credit requirement. I'll do cosigner. If I was looking at income, I would do a cosigner for that. I do cosigners for lower credit. And sometimes lower credit, I'll also look at credit history. I won't take a cosigner for eviction. I'm with only 18 units. I don't want anybody who's had an eviction if I can prevent it. in any of my rentals. And I think I have some because I purchased properties that have tenants that had evictions that were in there. But it's one of my screening criteria. I try to be consistent as much as possible so you don't face discrimination because maybe you let this person in, but this person seemed nice, and then somebody else points out some protected class that was between the two that made it a discrimination choice. So be consistent whenever possible. With the co-signers, Michelle, you're here in Washington. One of our requirements is that co-signer signatures are notarized. So that adds a little extra layer of making sure that's a real person and actually did sign it and committed to it. There's certain states have laws against you can do a larger deposit instead of collecting more rent up front. Some states limit deposit to 1 month's rent or 1.5 months rent or something. So know your local laws. The taking 12 months at a time of rent is probably legal, and because it's not a deposit. And I've never done it, and I don't know that I would resist if it was a case where like a parent said, "Hey, I'm going to pay for a year for my kid or something so they can be in college." But it's the mentality I've heard is people saying there's a reason why they have the money now and they know they're bad with finances, so they want to give it to you because they're not going to have it when that's over. So now you're just facing an eviction that far out, kind of like the emergency rental assistance program. They had free rent for a year. 13 months later, it's an eviction because they've had free rent for a year. They've normalized their spending with that not happening. I would consider it based on the story. So the cosigner thing gets me around a lot of things except for evictions. The income thing, if they don't have income, will they share bank statements? Can they show proof of paying rental history? Can, those other tangibles that can go there. And one of the main reasons that I don't look at income, Michelle, is I know people who make almost nothing. I mean, 15, 16 bucks an hour and are never late on their bills.
Yeah.
And I have friends that make $200,000 a year who are 3-4 months late on every bill and pay it when they kind of remember to. So I don't think that income to me has correlated to paying rent on time versus credit score, eviction history. Cosigners are a good one, especially if it's a cosigner they care about. Because you got two things. You got the cosigner that's probably willing to make good on it so their credit doesn't get hit. But then you got the renter going, I don't want to screw over mom because she's using her credit score to get me this rental. So you've got several layers there. The hardest part, Michelle, is making sure you come up with a system that you use every time so that you don't have discrimination problems.
Yep. Yeah, exactly. I couldn't agree more with that discrimination because you only get caught in, even if you're not discriminating, you only get caught in some sort of, hey, I made this exception because I met this person in person and they were really nice. So I made an exception to my eviction rule. And then it just comes back to bite you. So you just want to have that really clear and objective criteria up front and stick with it.
Cool. So I think we probably need to make some videos on a couple of things. There's a couple of new things coming out with Hemlane. And there's a question here from Wealth Building Journey. Thank you, Chester. That yes, if you would like to use Hemlane and you'd like a 20% discount on your first year, you can put Dion Talk in the application process to get that. And what I've had a few people do is actually just email Dana at Hemlane. Hey, I'm signing up and Dion sent me here. That seems to work also.
Email me anytime. I love hearing from you and answering your questions.
What I really like people to do is maybe email Dana, which is DANA at Hemlane. It's on the image there, .com, and let her know what your experience with the binder strategy was. This is what the tenant was paying. Here's what they're paying now. Just let her know what a couple of those experiences were. But the question there, thank you. You can get a discount for using Hemlane. But tell me, there's a couple things. First, one that's very exciting to me because I'm going to be spending the winter out of the country. I'm going to Panama and then Thailand. Vegas in the middle there because of the one rental at a time event that we will see you at.
Yeah.
Tell us about this lease signing change.
Yeah. So we launched a lease e-signing in app for you. So historically you could get e-signatures, but you'd go over to our partner, Rocket Lawyer, either upload your lease or use theirs. Now we have just a really cool feature, a really cool move-in process where once you click approve, it calculates a prorated rent for those of you who don't want to calculate, wait, is it on 31 days? Is it on 30 days? How do I calculate prorated rent? We put that all in. Here's the move-in funds. Here's everything. You can put the late fees, all of that in. And then once you do, you can upload your lease with all of that information. It's a drag and drop, and then you can get your lease signed in the app. It's really important to note all the tenants are going to do this via their phone. Tenants will not use a desktop, at least not in my experience. Most owners I see are on desktop. Most tenants, unless they're on the road with showings, most tenants will be on their phones. And so from that perspective, the tenants can view the lease and sign it, legally binding signature there, sign it online, and it's auto uploaded into your portal, mutually executed. So it's a new feature that we used to have externally a partner, and then we just brought it directly into the app.
What I really like about that, and this is based my personal experience with doing leases when I'm not in the area with the tenant, is I send it through email. I go, here's the lease, print it out, sign it, scan it, send it back. And it's happened. It usually takes a couple of weeks because the tenant has to, usually doesn't have a home computer, doesn't have a printer. Right? They're renters. This is their thing. They might be mobile or whatever. They have to coordinate a time at their work to use work resources to print their lease. Usually their work doesn't have a problem with it, but it's a day when they're there and they have access to it. And like some of my tenants are truck drivers because they used to work in the CDL world. And then they take it and they sign it. And then they got to find a way to scan it back in. So it's cost all of this extra steps for them, which it doesn't impact me, but I know I'm impacting them. So if I can do this to make it easier on the tenant, which is kind of like when it comes to collecting rents, which is the second thing I want to talk about, that's why I do that. I want to be able to just send a thing on the phone. I know it's worked with me. My first realtor, no kidding, he has 30 rentals. He had a Windermere office with 19 agents working with him.
Okay.
And my first time I went to make offers, we would meet in his car and he'd bring out a stack of papers like this. And I'd initial, sign, sign,
Oh
sign.
my
Like I thought
gosh.
that was normal. This was like
Yeah.
2013. It wasn't in the 90s. And then I got my next agent and he's like, hey, I'm going to send this thing in your phone. You just click it. You just hit the next, read the lease if you want to. Done in like 5 seconds. So if I can do that with the tenants, that'd be much easier too.
Yeah. The one caveat I give with it, and it's written, we send the email out to the tenants and then the text message to them of, hey, here's the lease for you to sign. And we say at the bottom, like there's typically a 24 to 48 hour turnaround that you're going to need because they might have to go to the next applicant. So adding some sort of, hey, you need to make a decision and let us know because we're going to be requesting the move-in funds at the same time. So you got to get everything in line. The one thing I would recommend with it is tell the tenants, please make sure to read the lease. I've always found with e-signature, to your point, you just click next, and sign. And really what you want to do is say like, you are signing up for every single term in this, the late fees, the what you're doing for maintenance and repair. And so I always just remind the tenants, like, please make sure you read this in detail, just to make sure you and I are on the same page and we have one document. And so, if you can do that, I think that really helps just show, hey, I'm trying to be fair. I want to make sure that you know exactly what you're signing up for.
Nice. Well, I want to be respectful of your time. We're going to wrap this video up here. Not in the comments during the live, but in the comments section after that. Can you guys let me know if you enjoyed this? Because I'd like to have Dana back for another live. I think we make videos good together, well together.
Yeah.
But I like live streams more because we get the interaction of the people in the comments that are actually out there buying properties, looking for a way to manage it, and looking for the knowledge that comes from people like you.
I love it. Thanks, Dion, for having me.
Awesome. Until our next Dion and Dana talk, have a day full of amazing. And we are off of YouTube.
I love